Welcome everyone to tonight's Sunday macro wrap up for Sunday, July 20th. Already close to the end of July here. Man, the summer has just been rolling by fast here. Getting into the early fall months here shortly. Just for those of you that are joining on live stream for the first time, the way that these Sunday macro wrap ups work is that they're an hour long. First 30 minutes is streamed. Second 30 minutes is just for our Macro Optics members who are on the Zoom call right now. And so if you'd like to join the other 30 minutes that are offline, where we're going to be discussing actual ideas and some other things that, translating all this knowledge into, looking at the charts and tickers, you can go to our website using the link in the description below in order to check out the 7-day free trial of our community there. But with that, we'll go ahead and get rolling on in here. With last week, we saw that the CPI did tick up to its highest level since February of this year at 2.7% year over year. This is a 2-month acceleration. The market wasn't too happy about that, although, it's something that, we've been talking about for quite some time. Can you guys hear me now that are on the Zoom meeting? Sorry about that. Perfect. All right, so at the beginning of the week last week, we saw how inflation accelerated. This is something that, we've been talking about for quite some time, only because we've seen the rate of change accelerate for, oil, some other commodities, precious metals, that sort of thing. And that has obviously been leading to inflation reaccelerating in the real data. Always pay attention to what the leading indicators are showing. And still, the leading indicators are showing that, it's going to remain, semi-sticky. I wouldn't be surprised if inflation next month comes in exactly the same at 2.7%, which, again, that's nowhere near the Fed's 2% target. Someone sent me a DM over the weekend saying, like, hey, inflation is down from 9%. Why, inflation's pretty low now. 2.7 is pretty close to 2.0. Why can't they just start cutting rates? Well, you have to realize, like, a percentage point in inflation terms is a lot, right? It's almost like when you think about, I don't know if any one of you ever did competitive swimming, but or track meets or anything like that. But in those types of races, milliseconds matter a lot. Whereas the same thing with the inflation rate, just 0.1% is a lot, right? And so, before the pandemic, between 2008 and 2020, if the inflation rate was at 2.7% like it is right now, all hell would break loose, right? The average inflation rate, I think, was like 1.7%, right? And a lot of the time it was below that too. So 2.7% over the past 20 years, that's still a lot higher than average. All that to say is that, this is really putting the Fed between a rock and a hard place, because they really can't cut without, inflation fears reaccelerating. And the biggest thing that the Fed cares about is their reputation, right? They don't care as much about you and I, and they don't care as much about what Trump is doing or what the White House is doing. They care about mostly what their reputation says about themselves. And so we did get some other, more positive headway with inflation by looking at the producer price index, right? So PPI actually did come down to its lowest level since September of last year. But you have to understand that PPI, it might have might be a better reflection of domestic inflation, because it doesn't take into consideration imports, where CPI does take into consideration imports. But really, it's what the consumer is facing, right? Really, what this is showing with producer prices, inflation continuing to come down as consumer prices remain elevated, is that margins are pretty much going to be maintained, which could be bullish for companies, which I mean would explain why the market has been going up, right? Margin expansion is pretty good news. What's interesting as well is that we saw the Empire Manufacturing Index. So New York manufacturing did have a positive month. That was the first time it was positive since February of this year after a 4-month negative print. So a little bit of positive development on the growth side, but not crazy amounts. Manufacturing still remaining positive. Another positive note there. Looking at retail sales year over year, a lot of people were saying on the headline news that this was a great acceleration with this right here, or on a monthly rate. It did have an acceleration, but as you can see on a year over year, it was barely an acceleration. And then when you look at the core retail sales, which is the retail sales control group, this right here showed a 5-month deceleration to 4.1% year over year, right? And so the retail sales control group is really a better measure of retail sales because, it takes away some of the more volatile components and really takes a look at like discretionary spending. And the retail sales control group is really what is a better measure of like what gets incorporated with the consumption component of GDP measurements, right? And so that continues to go down. And so with the rate of inflation remaining sticky, with obvious consumption measures either staying flatlined or going down, it's really this same environment of higher than average inflation, pretty much stagnant growth, and that's stagflation, right? That's really not the place that the Fed wants to be in, as well as at the same time, the government is kind of in a panic because they need rates to come down because pretty much over the past 2 or 3 years, or more so 3 or 4 years, the federal government has been funding itself by issuing short-term debt that rolls over really quickly. And so every single year that passes by, there's a larger amount of debt that they need to roll over, which is very dangerous, and it's not something that's sustainable at all, right? That's how you really get deficits as a percentage of GDP just to get out of control. And then you run the risk of a debt spiral. You have the debasement and pretty much the confidence of the U.S. government and their treasuries start to be undermined, and that's how you get into a 1 in 500 year regime change, which I think right now is the really the first time in a long time that is being stared down the barrel of. But not saying that that's going to happen, but what is happening right now is that the band-aid of issuing debt at the short end is starting to become harder and harder for the government to do. That's why Trump is like, Powell, you need to lower rates. We cannot do this for much longer. And Powell's like, I can't. Look at inflation. So we'll get into more of that discussion here in a little bit. But moving on to some of the other metrics that we saw last week. Despite all of that, we saw the Michigan Consumer Sentiment Index rise for the second month in a row. This is showing, a potential rebound in sentiment, as well as the 1-year inflation expectations came down for a second month in a row. So that is interesting there. We also got new single-family housing starts, and that's continued to be negative year over year at negative 10%. So the housing market still not doing too well, and that's part of the reason also too why the government is asking for the Fed to lower interest rates, because I mean the housing market is just, I don't know if you guys have been seeing some of the recent reports lately, but the demand destruction is definitely apparent in a lot of the hot markets like Texas and Florida, where I live. You go around to some of these neighborhoods, you're seeing more and more for sale signs, and if you go on Zillow.com, you can see how there's more and more price reductions at a faster rate, right? And then there's some people who are just taking their homes off the market entirely because they're like, man, if I can't sell it, then I'm definitely not going to sell it right now and get into a new home where, interest rates are, 7%. So, yeah, the housing market is definitely, still struggling. It has been holding up though, surprisingly, but that's kind of like the big iceberg in the water. Taking a look at the target rate probabilities for the July Fed meeting, that's pretty much a guarantee that they're not going to cut rates. So we have to look at the September meeting, which right now it's about a 60-40 split between cutting by 25 basis points and staying where they're at currently. This 40%, this 39% chance that they're going to remain paused in September. If we continue to get inflation reaccelerating and more of the same of what we've been getting, mainly looking at the 5-year break-even inflation rate, this metric right here, which you can calculate on your own using those tickers, right? If you subtract these two, you'll get the real-time. I think this is updated, every single day. But you'll get the most recent 5-year break-even inflation rate. But as you can see here, pretty much since the end of June, this has been accelerating, and it accelerated to new highs here. I'm not sure if the market is, pricing this in yet, but yeah, at this rate, I would not see a September cut, right? So in that case, you'd be looking at November. But the market clearly has not been looking at that too deeply, even though it has, I think, like 6 or 7 weeks ago, this was at 2%, and now it's at 39% chance that they remain paused. So it's clearly trying to price in something there. Now, heading into this week here, it's a little bit of a lighter week in terms of macro data here. We have some, growth measurements such as the Richmond Fed Manufacturing Index, as well as flash manufacturing and services PMI on Thursday. And then we also have Jerome Powell speaking on Tuesday at 8:30 a.m. Not sure what this is for, though. Some conference. So we'll see if that will be anything. He'll probably say the exact same thing that he's been saying, which is they're not cutting rates. One thing I also forgot to mention that happened last week was, not sure if people noticed this, but they did a little bit of a test run with the whole Jerome Powell getting fired thing, right? And a lot of people in the media, financial media, were saying how the market would welcome Jerome Powell getting fired so they can lower interest rates. Well, when you take a look at this right here, let me go to this on the hourly. On that day, when the market was pretty much sure that they were going to fire Powell, the market had a pretty large dip, right? If you take a look at the SPX, that went down to, it wicked down to, let's see here, the low was 62.01. So it did the exact opposite effect. And then right after that, what did Trump do? He's like, oh no, I didn't call for his firing. No, I'm not going to fire him. He backed off really quick. I don't know if you guys noticed that. But they did a little trial run last week with the firing of Powell, and the market did not like that at all. So, hold on one second here. All right, one second. So I don't know if people caught that there yesterday or last week, but I thought that was pretty interesting. All right, let's take a look more of what's to come this week. We also have the interest rate decision for the ECB, European Central Bank. They're most likely, they've guided that they're going to remain paused because, their interest rates are rising as well, right? So their 10-year U.S. government bond yield has been rising as they've been cutting. Essentially, their bond market is saying you shouldn't be cutting right now, right? And so they're finally listening to that, and they're most likely going to pause for the first time um, in quite some time here. So that'll be interesting there. Oh yeah, last week too, we also saw how they passed the Genius Act for stablecoin regulation. Um, the market, it was kind of like a sell the news event with the cryptocurrency markets. This is essentially the institutionalization of crypto, and it's a double-edged sword, right? Because you want to get TradFi into this because that's where the big money is at, but in doing so, you're kind of taking away the entire decentralization aspect and the deep banking aspect of crypto. It's a whole debate that you guys can go down the rabbit hole on X or Twitter, and yeah, we won't discuss that here. For me, ultimately, I think if you want to transform the TradFi system, you have to become a part of it and then kind of like blossom into the new type of TradFi, right? So I think that's just the natural part of things. And, I think part of the reason why we're seeing these altcoins rally and that's making this kind of like a risk on environment is because of the whole, bond issuance, um, you know, uh, kind of the debt spiral that is happening, and more investors are watching, right? I think investors aren't dumb, and in this day and age where a lot of people have access to financial media, buying the ability to buy stocks and other assets is relatively easy compared to 15, 20 years ago. And so I think the average investor is a lot smarter, and they see what's going on here, right? With just the way that this government has just been out of control spending, and I think people are just hedging themselves, and I think that's partly why cryptocurrencies are spiking the way that they're doing, is because people are just reading between the lines here in terms of the crazy debt cycle that the government's getting themselves into. In other news, though, we have big tech earnings this week with Google and Tesla. We also have Coca-Cola and Philip Morris, IBM, T-Mobile, some of these other ones. But yeah, we're in full-blown earnings season now. Oop, the camera kind of got blurry there. So yeah, looking to Google and Tesla. Tesla did have a decent sell-off last week. Or no, I'm sorry, I had a decent jump last week, but it still remains in bearish trend. And then Google, also definitely not as bullish as some of the other Mag 7 stocks, but it is in bullish trend. And so, yeah, I mean, it's getting closer to its all-time highs here. So we'll see how that goes too. But I mean, if something is rallying into its earnings, you just got to be aware of where it's at in terms of the trading range. And so I think that is on Wednesday for both of those. But yeah, earnings season is kicking off here. What else do I have for you? Okay, also as well, we had the July Bank of America Fund Managers Survey. And as you can see, I mean, they're pretty much all risk on. So the title of the YouTube video for this stream is Big Money is Long or Big Money is Bullish. And that's because as the historical V-shaped recovery has happened in the equity markets, we saw just a huge rotation back into risk on. So tech stocks really is just where all these funds are overweight, and then also too the cash levels for fund managers dropped down below that 4% level, which historically has been their quote-unquote sell signal, although there has been points in history where if you were to sell during this time, it wasn't the most opportune and the market kept on going higher, but it could be a signal that we're just starting to get to severely overbought levels. And I mean, that would make sense, right? I mean, I think that puts are cheap, right? So buying downside protection is pretty cheap right now relative to what it was, just 2 months ago. And that's really when you want to do it, right? And so I wouldn't be surprised if we did have some type of correction, especially as we get closer to that August 1st deadline for all the tariff stuff. So we'll see what happens there. But one of the biggest changes that I saw for the month of June was when we take a look at bond issuance here. So this is United States Treasury security issuance. We saw that bill issuance for the month of June was at its lowest level since September of 2023, which that's a big switch in direction. As you can see here, bill issuance has been dominating pretty much for the second half of the Biden administration under Treasury Secretary Janet Yellen, but ever since Trump got in there with Scott Bessent, he did keep it relatively elevated, continuing Janet Yellen's playbook, but the month that we just saw from May to June, that was a pretty large deceleration, right? So in May, 2,100 bills, or I think that's in the billions, right? Yeah. So 2.1 trillion bills versus 1.6. So that's a pretty significant drop, and then a large increase in bonds, longer duration. And so what happens now is if the Treasury Department is being forced by the market to cut back on its shorter duration Treasury issuance, that means that the Band-Aid is starting to, they're not able to do the short-term Band-Aid that they've been able to do for the past 3 years. And so this is furthering the evidence of this no landing scenario where you could really have a risk of a debt spiral. And I think partly too, that's what cryptocurrencies are seeing right now. And we still have both the 30-year as well as the 20-year Treasury bond yields, close to 5%. It has come off of the highs there, but as you can see, pretty much since the beginning of July, right? Looking at the 20-year U.S. government bond yield, I mean, this has gone up by 447 basis points. That's a huge jump, right? Same thing with the 10-year as well as the 2-year. Now they've since had a little bit of a cool-off period last week, but again, if we continue this cycle, then I wouldn't be surprised if we saw 30-year and 20-year yields north of 5%. Which, if that happens, then you'll start to see some panic for sure between banks and others. So we're right on that cusp of this turning into something not so great. But still, I mean, that doesn't mean you just panic sell everything. There's always going to be assets that do well in that environment. You just have to look for the bullish trends as that's happening. And right now, you have things like cryptocurrencies, you have things like gold. So there are options out there. So it's not just like doom and gloom, right? You just have to be able to switch around where the flow of capital is going. So that's pretty much what I'm seeing here. The strongest bullish assets are still high risk assets like the Nasdaq, Bitcoin, and other precious metals such as platinum and palladium. Just taking a look at both of those two charts here. I think that both of them have had I guess on Friday, they were having a little bit of a correction here, but still, they've had massive accelerations here, and that's also a testament to where it thinks inflation is going. But yeah, that's pretty much all I have. Let's take a look at the consumer discretionary versus staples. This continues its bullish trend, also showing that it's more of a risk-on type of environment. So the risk-on short-term aspects could continue. We are due for some type of correction. I'm not going to try and predict when or how or what magnitude that will happen, but we've been signaling to our groups to raise cash in the select assets that we are bullish on in order to buy lower. So yeah, in which case, we'll continue to ride winners and be looking for opportunities when that correction arises, and it will happen at some point. Maybe it'll happen as summer comes to an end here, and Wall Street gets off the beach and back behind their desks. So yeah, that's pretty much all I have for the people who are on the stream here. For those who are on the Zoom call, stick around. I'm going to go ahead and end the stream. We'll say bye to the social medias, and we hope that everyone has a great week out there, and good luck.